That are going to move this market in one direction or another, but today it's just not clear that we're going to get the answers to that question. So maybe a flattish open in prospect. Let's find out. It's time for the opening trade. These are the numbers I have for you. This is the direction we're moving in, and at the moment, as you can see, we are moving. No, the FTSE 100 just went through a phase there. Did you see that? Of zero either side. Basically, we are moving just a few ticks either way. The Stock 600 is absolutely flat as a pancake. It is not often you see a market open where the Stock 600 at this point actually just has zeros. And there you go, there's the FTSE 100 just with zeros. The IBEX is moving a staggering 0.01% to the upside. The DAX is moving in the opposite direction. Everything seems to be balancing out nicely. At an index level, I am struggling, Val, to find much sense of direction and much to talk about. So I'm going to hand things over to you to give us some excitement.
Well, when it comes to the sectors picture, we are looking fairly balanced. We have around 8 sectors in the green, the remaining 12 in the red. At the top of the basket, we are seeing energy stocks perform the best. Vestas Wind Systems actually driving a lot of that gains. To the downside, we do have sectors like media, but I do want to note one of our stocks to watch, Novonesis, that we thought could actually rally on some better growth targets, is actually the worst performing stock this morning, down over 7%. This is an enzyme company related to the pharma space in the Netherlands.
Catalyst.
A negative catalyst there for Novonesis, down 7%. But the sectors picture at the moment is increasingly turning more red across my screen. We only have 4 sectors now in
Anglo's XD, AIB is XD, Babcock's XD, IHG is XD, Legal & General is XD, Schroders, there's a whole raft of others as well that are all ex-dividend this morning. So just bear that in mind when you look at the numbers.
Look, I thought broadly this week we would have European stocks outperform because of the better-than-expected Russia-U.S. meeting in Alaska, but that's turned out to be not necessarily the catalyst. But overall, European stocks have outperformed U.S. peers this week, and a lot of that is down just the weakness in the tech trade.
So it's interesting that Shell is up, so you can argue that if you are reading the Ukraine story now as more negative, you would think that oil prices potentially could go higher. We were talking about this earlier on the show. So Shell is tracking a little bit higher. It's up by 1%. So that's interesting. Interesting that Rheinmetall this morning is a little bit higher, maybe also indicating maybe that the conflict is likely to continue, maybe in its current form. Rheinmetall is up by 1%. Rolls-Royce is tracking a little bit higher. BAE Systems reacts a little bit to the upside as well. That's where the move is coming from. If you're looking for some positivity maybe is the wrong word, but it's maybe actually the Lavrov comments, this idea that actually there are going to be no security guarantees that are going to work realistically, that the conflict is going to continue likely in its current shape. That would certainly seem to maybe being priced into the market this morning.
Yeah, still a lot of questions on the security guarantees and then how they would feed their way into the European equity market is obviously still a question as well. But joining us now is William Sells, the Global CIO for Private Banking and Wealth Management at HSBC. Thank you for joining us on this snoozy August Thursday, we'd like to call it, but inject some excitement around to this table. How are you thinking about the AI trade? Because I think that's really captured a lot of the interest when it comes to the global equity market this week. The hit that NVIDIA took in the session yesterday that was bought. How are you thinking about this negativity and where it's come from?
Stick with the AI trade, because we're going to have the combination of that AI liftoff, which we're seeing across industry and the real economy, as well as the Fed rate cuts, which obviously are going to support the growth stocks. It's natural ahead of Jackson Hole, where a lot of the rate cuts are already priced in, very high expectations together then with the NVIDIA results coming later. That the market is a little bit wobbly here.
Yeah.
There was a lot of chatter over the last few days about value versus growth and how much growth had outperformed performed. So I think it's not surprising that we have a little bit of a profit taking. But I do think that you need to stick with that AI trade, but basically broaden it out across the ecosystem. So that includes the infrastructure, it could include even the energy provisioning for all of that. And that's what our clients are doing.
Look, Willem, I do agree that there does seem to be profit taking, at least on momentum type trades. But overall, tech is quite resilient to monetary policy. So why would you be taking tech off the table, given it's maybe less likely to move if we get a surprise from Jerome Powell on Friday?
So given that a lot is priced in, I think, in terms of those rate expectations, if we don't get it, then obviously growth stocks could potentially see a little bit of a hit. But I do think that ultimately, number one, we do think that you're going to have the cuts.
Yeah.
Number two, I do think that you need to look at the earnings picture, where now actually expectations looking ahead, because companies have done so well, the growth figures in terms of earnings growth for analysts for the tech are actually reasonably low, the Max 7 in particular reasonably low, and we could have positive surprises. And then, the fact that this is spreading across industries and therefore gives you a lot of opportunity to sort of widen that trade, even also into China, right? Because a lot of the AI companies, tech companies, they are trading at 30-40% discounts.
How would tech do in a recession?
So a lot of the tech companies are seen as quality companies, and that's how they have behaved over the last number of quarters. So I do think that
at current multiples,
you could potentially, you have the shrinkage in terms of sort of multiples coming from the growth side. But then if you are looking for lower growth and therefore then have lower interest rate expectations as well, that could offset it. You would have probably a little bit of a dip in multiples, but not extremely so. You would probably still be better off in tech than in a lot of the other industries.
On a relative trade or on an absolute trade? Okay. What questions are your clients asking right now?
So market narratives change, and therefore client questions change as well. So there were a lot of questions around erratic, policy making, around the debt pile, therefore around de-dollarization, and therefore do I need to flee from the US? And so we've seen that in the data that people have not fled, right? There's been a little bit of a dip in bond buying and equity buying, but not a huge amount from foreigners. Now the story has changed a little bit, and it's about, well, the US is dominant, 2/3 of the equity market. Tech is dominant within the equity market, and then you have US dollar weakness. So for other reasons, we need to kind of diversify. Again, not flee, but diversify. So
because of the dollar weakness.
Because of the dollar weakness, the fact that you own, as any investor, if you buy the market, you own a huge amount of tech, you own a huge amount of the US,
right,
and you have a US dollar weakness. So I'm just very exposed to that trade. Do I need to actively diversify? That's the kind of question. And so I would say from a sector perspective, certainly diversify into financials, into industrials as well. Industrials also benefiting actually from the trade, so not completely uncorrelated. From a geographical perspective, we do like China, Singapore, and UAE, small market. And then obviously now, there is a reason to start to diversify more into bonds again. People have been sitting on cash. It was comfortable and it was reasonable as the Fed was in a wait-and-see mode. But as we now are coming really to the next, interest rate cuts, you need to start to lock in, those bond yields. And we're starting to really see those flows now.
Are you talking about sovereign bond yields, or are you pushing clients into credit?
Quality. So, private clients will typically prefer investment grade for that little pickup. As long as they're comfortable, it won't widen too much. The real discussion, though, is how far do you go in terms of duration? And as the curve is very flat up to the 5-year point, it's really interesting to try to pick up a little bit more duration than that. So maybe do a little bit less in terms of notional value, but go beyond the 5-year point.
You mentioned you also looked at diversifying into China. China tech stocks something you're willing to take a look at these levels?
Yeah, I do think that they at these levels 30-40% below other markets, and I do think we are starting to see also now from Western investors more flows into China. We're seeing that in the industry-wide data as well, but we are seeing it in our business. And that is in part because they see all of the tech innovation and the valuations, and they're looking for, and that diversification from the US, but also this topic which we all hear a lot about. I think the anti-involution, the supply side reforms, because a big reservation from foreign investors had been the deflationary forces, overcapacity leading to very low margin power for companies. Is addressing overcapacity going to lead to higher earnings expectations and therefore more sustainable upside? Clearly, people are still underinvested. So if those flows go in, it can push the market up.
Does the US equity market need rates to be cut to maintain current levels and continue to push on from here?
I do think so. Yeah, to some extent that we do need the cuts. We have 3 cuts penciled in for September, December, and March.
Right.
You have quite a high real yield, both compared to other markets, right? Compared to the UK, compared to Japan, compared to the Eurozone, different economies, I know.
Sure.
But quite a significant real yield, both on the policy rate side and on the 10-year Treasury as well. So I do think that you can have a number of rate cuts while still remaining in a restrictive, monetary policy environment. Obviously, then the market turns that into, quite generous financial conditions by being, having such tight spreads and such low volatility. But I do think that the Fed can cut it a few times.
Philip, nice to see you. Thanks for stopping by to see us. Philip Sells, Global CIO for Private Banking and Wealth Management, joining us from HSBC. Quick look at what is happening in Europe. The answer, to be honest, is not a lot, and you can see that on the screen in front of you. A little bit of weakness coming through maybe in Nestle. There's a few XDs out of the London market. Defence is coming back, and I do wonder whether that is related to the comments we've seen from Sergei Lavrov, indicating maybe that actually any kind of security guarantee for Ukraine is going to be hard to produce and make work with current Russian views on that subject. LVMH is a little bit softer, down by 0.7%, and you've got not much else happening elsewhere. But Chloe Melly is here with some details of things that are moving. Chloe.
Good morning, Guy. Let's start with Aegon today. So Aegon reported operating profit that beat estimates by quite a large margin this morning, and it also increased its buyback. So that is leading the shares up this morning. We're up about 7% for the insurer, so quite a good day for Aegon. Moving on to defense. So defense stocks have been going up or down depending on what the market sees as the likelihood of this peace deal in Ukraine. At the moment, it seems that this potential peace deal is looking a little bit more unlikely, and that is driving the shares of those defense names this morning. So Rheinmetall, Hensoldt, Leonardo, BAE, all in the green this morning, which is a reversal from what we saw yesterday. Moving on to Safran. So Safran is an engine manufacturer. It's also a little bit exposed to that defense trade, but it's mostly up on the back of an upgrade from Bernstein, which said that there was really a great aftermarket performance, and this aftermarket segment has really been driving the earnings over the last few quarters, and it seems like that will be continuing for Safran. So we're up about 1% this morning. Moving on to CTS Eventim. So this is a bit of a smaller company. It is in the ticket business, so tickets for concerts, theatre, sporting events, and it reported profit that missed estimates this morning, and it's not being rewarded by the market at all. We are down 17%, so a major underperformance this morning, and perhaps a little bit of an indication of this live entertainment sector having some tough times ahead. And finally, Novonesis is also down. We thought it might be up, maybe perhaps on the targets for 2030, but those may have disappointed the market this morning, and the enzyme maker is therefore down.
All right, Chloe Melly from our equities team, thank you for the update on the recent movers 12 minutes into the equity session. We also have some headlines around Zelensky we want to bring to you. He has been speaking to reporters, saying he sees positive signals the U.S. may join security guarantees. Guy, I know we were just talking about the Russia's side of the view on that situation.
He's ruling out a meeting in Moscow with Putin. He is ruling out Hungary as well. He sees Switzerland, Austria and Turkey as possible venues for such a meeting. Remember that the Russians, to a certain extent, are kind of backing off that idea that you could see a Putin-Zelensky meeting. Peace talks should take place in neutral Europe. He's sort of, I would say, maybe being a little bit cautious in terms of managing expectations around whether or not this meeting will actually take place. The more that's ruled out, the harder it is to rule things in.
Well, they're talking about a location. Maybe that's a positive signal in itself. No?
Maybe.
Guys still underwhelmed on the situation. But coming up on the show, Oaktree's Capital Howard Marks says the U.S. stocks are in early days for a bubble. We'll hear more from our interview next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest.
Every trading day.
Only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
French PMI data breaking onto our screens right now. 49.8 is the comp number, up from 48.6. So basically, we're at the flat line on the French data. This is the line you have from market PMI markets as they produce these numbers. After a sustained period of contraction in the Eurozone's second largest economy, August flash PMI data showed signs of stabilizing business conditions as French private sector output was largely unchanged on the month. More excitement. We're unchanged.
More excitement, but yeah, I guess you see it reflected in the euro. We're slightly higher, though it did test its 55-day moving average earlier in the session. Dollar weakness has been a key theme. Maybe these strong PMIs, if they continue to roll in across Europe, will be something that will change that.
We'll look for more data a little bit later on. Remember, Lagarde's going to be speaking as well over the next few days. We'll watch her, along with all the other central bankers that are going to be giving us commentary on what is happening in the world right now. Somebody else that's been giving us commentary on what is happening in the world right now is Oaktree Capital's co-chairman. He, of course, is Howard Marks, and he's warning that U.S. stocks appear to be in the early days of a bubble. Mark spoke exclusively with Bloomberg about his concerns over rising valuations and investor complacency.
This is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality, the outstanding reason, I think, is that, there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen, whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we're probably in the early days of that.
When you talk about liking, Howard, maybe liking these assets a little bit too much, can you put into perspective the last time you saw this type of environment that left you thinking maybe some of the opportunities aren't as great when it comes to buying some of these assets at current valuations? Is there another time that this sort of reminds you of in any capacity?
Well, I guess, Lisa, the last time was probably around 97, when the market was kind of falling in love with tech stocks, and the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet, Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. So remember, I said we're in the early days.
97. It's interesting that actually Thorsten Slot yesterday put us at 98. He put us at late 98, I think. I don't know. How do you pick these things? It's hard to say. I think what he did say there was just interesting is that there's this kind of bias within the market to continue doing what has worked until it doesn't. Mm-hmm. But nobody believes that it's ever going to get to that point. You just continue going. Calling whether we're 97, 98, 99. The party's going to finish at some point. I don't know whether the party's just getting going.
But it's like not getting close to midnight, right? That's what they're saying.
I think probably most good parties don't end at midnight. They end at 2 a.m. I'm just going to point that out. They go way beyond where they probably should finish, and that's kind of the point. I don't know. How do you call this one? It's hard to call. There are some metrics that say we're beyond 2000. There are some metrics that say we're in the early days. It's what he's saying is that the market cannot conceive of a different world than the one that we're in at the moment. It cannot conceive of mean reversion. It cannot conceive that things change into a different operating environment. And that does feel like it does resonate at the moment. Nobody can quite get their head around the fact that stocks don't go up and always will continue to go up. That seems to be the narrative that has existed for a long time, and people don't believe that that's going to change anytime soon.
Yeah, but I think this week people have gotten a bit more sensitive to this negative news that we've seen. Even take at what happened with Meta, restructuring their AI organization and having a hiring freeze. At some time.
Do you still buy the dip?
Well, they did yesterday.
My point. My point exactly.
All right, moving on to some European auto stories. Volkswagen pivoting once again on its bet on electric vehicles. The automaker had set its ambitions on selling more EVs globally than Tesla by this year, but that was back in 2021. Let's get more from this story on Bloomberg's Global Autos editor, Craig Trudell. Thanks for joining us this morning on this Volkswagen story. They set out some big ambitions, put a lot of money behind it. What's changed now?
Yeah, I think we can sort of rule out the likelihood that they will outsell Tesla globally this year. They will, however, they are on track to pull back ahead of Tesla here in Europe. They are getting some momentum, at least in some regions and with some models. Do they have a sort of smash hit EV like a Model Y? I think it's safe to say they do not. And it's really been an up and down decade, right, where you had some real issues with trying to replicate what was working for Tesla with throwing a lot of money and a lot of people at software, and it turns out you need more than just that, right? You need to do software well, and I think Volkswagen is still very much figuring that out. And so we've seen some indications that parts of this vast group is going to pump the brakes a little bit on EVs, in part because of the issues they've had with developing software internally.
What do customers want to buy right now?
I think it's a complex question where there are still a lot of consumers who are reluctant, and I think we can look at Bloomberg Intelligence has been doing regular surveys where they find this very consistent reluctance on the part of consumers.
But isn't that kind of marketing 101? You give the customer. What is the customer asking for? You give them what they are asking for because ultimately they're probably going to buy it if you do that.
Well, and I think, we do get to this question of how much of this is consumer demand, some of this momentum, versus how much of it policy, right? And it is the case that so much of the European market is company cars, right? And so there's maybe, sort of you get a option of sort of a menu of cars presented to you by your employer in some cases. Sometimes you don't have a choice whether or not you go electric, right?
Right.
And so
that's still a thing. I thought company cars had long.
It's still very much a thing in Europe, and it's something that really sort of Americans, have trouble grasping that. But in China, right? I think it's a different story where we are still seeing serious intervention on the part of governments. But we're also seeing legitimate consumer demand of people wanting to go out and buy a Xiaomi, wanting to go out and get a BYD. And they're doing that because, the range is great, the charging, experience, it's sort of closer or at least getting there in terms of an equivalent to fueling up. And that's attractive to a lot of people.
Val's in the market for a new car.
I am in the market for a new car. If you have any recommendations for a mid-sized SUV, I'm all ears. But what's Volkswagen's plan moving forward? Are there big ambitions just going elsewhere?
I think in China, it's going to be very interesting that they're really going the partnership route. I think in terms of software, there's a consistency there as well, where they were trying to stand up an internal software effort called Cariad that has really been just sort of an unmitigated disaster. I think in the U.S., it's going to be interesting as well, where trying to, you mentioned being in the market for an SUV, they're really trying to go more in the direction of where the American consumer is, which is pickups and SUVs. The question I think
see
though
you in a
is
pickup.
Large cars.
I could see
whether
you.
or not,
Yes.
whether or not people want electric trucks or SUVs is still
Another question. Yeah, that's right.
Yeah, they don't fit in London. We have this debate constantly. It's a struggle. Craig Trudell, very nice. Thank you very much indeed. Coming up, we're going to talk about the data. Jennifer McEwen's going to join us. That's next. This is Bloomberg.
Applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, they will provide a very strong market.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back to the opening trade. We're 30 minutes into the cash equity session, but the focus is now on the PMIs. After we got better than expected French PMIs and got a boost in the euro, we're now looking at the German numbers dropping. Composite PMI rising to 50.9. The forecast was for 50.2. So better than expected PMIs out from France and from Germany. Remember, this data is the first data prints that we're getting from when those higher reciprocal tariffs were hitting the Eurozone economy. And so far, it is looking pretty good. Euro headed towards session highs, but trading flat on the session. Guy?
Let's talk about what is happening out there in terms of the market moves that we are watching. Not a shock that you see this number, 54.5, negative 54.5, i.e. volume is pretty anemic today. In terms of the market move, we're pretty balanced, 241 up, 333 down. Defense is doing a little bit better. You are seeing some of the tech stocks still a little under pressure this morning. I tell you where you are seeing a bunch of 52-week highs today, and that is in the insurance space, which I think is quite interesting. Aegon is hitting a 52-week high. The Dutch insurer is up on the year by 18%. Let's call it 18%. Spike here that you can see to the right-hand side of the screen on the back of the earnings. This is propelling this stock sharply higher this morning. This earnings report that we've seen this morning, better than anticipated. But the entire sector is doing a little bit better this morning, and Aegon certainly the catalyst for that. That's the 52-week high. There aren't many out there this morning, many exciting ones, at least that we're watching carefully. What else do we need to know this morning, Val?
Well, here's what else you need to know on this Thursday morning. Federal Reserve Governor Lisa Cook says she won't be bullied into stepping down from the central bank. This is after President Trump called for her resignation over allegations of mortgage fraud. No charges have been filed against Fed Governor Cook. And U.S. Vice President J.D. Vance says negotiations over ending Russia's war in Ukraine are focused on security guarantees for Ukraine and territory that Russia wants, which include some land that's currently under Ukraine's control. Meanwhile, it's reported that Russia's foreign minister says Moscow and Beijing must be included in any Ukraine security guarantees. And lastly, the UK's budget deficit shrank more than expected in July as a deadline for paying self-assessed income tax boosted the Treasury's coffers. Spending exceeded revenue by £1.1 billion compared with £3.4 billion a year earlier. It was the first year-on-year decline in borrowing since November and the lowest July borrowing for 3 years. Guy?
Okay, let's go back to some of the data that we're watching. We'll come back to that UK story in just a moment. I just want to reference what is happening with the German data this morning and the French data that we've seen in terms of the PMI numbers. Better than anticipated. And this was when we were suffering as well from the uncertainty around what the tariff story was going to be delivering. So actually, you put that into the mix, and maybe this data does look significantly better than anticipated. We'll come back to the UK borrowing story as well. And of course, we've got to talk about what is happening at Jackson Hole a little later on this week and the lessons we're going to learn there. Jennifer McEwen, Chief Chief Global Economist at Capital Economics, joining us around the table this morning. Good morning.
Good morning.
Better data out of Europe. Should I get excited?
Well, no, those are very small. Those are very small moves, right? And we're still looking at PMIs, hovering around the 50 mark, which is supposed to be consistent with no change in GDP. Yep. So it's nothing to get excited about, but it's a bit of a relief. The big news since the previous PMI has been the trade deal, which is a bit disappointing, that 15% tax. So it could have been that you saw a worse effect. We saw both the Centix and the ZEW surveys deteriorate a little bit this month. So it could have been that followed through to the PMIs, which are more relevant for activity.
If I'm Christine Lagarde, I'm looking at this data. Do I think policy's in the right place?
Yes, I think so. I think the Eurozone feels a bit like an economy at equilibrium at the moment. That's always a risky thing to say, but with growth at 0.2%-ish per quarter, inflation around 2%, interest rates around 2%, I think I'd feel fairly comfortable. I mean, not excited by it. You'd much prefer, obviously, the growth was a lot stronger, but, it's the Eurozone. It's not grown strongly for a long time, and things feel broadly stable.
But Jennifer, at the same time, this manufacturing print, we're nearing expansion, and it's the best print that we've seen since the middle of 2022, and this is an economy that's supposedly buckling from tariffs. Do you think that kind of flies in the face of this narrative that tariffs are going to have an impact on the economy when German manufacturing seems to be doing okay and slightly rebounding?
Yeah, I mean, it's early days, and I think the caveat there is he said nearing expansion. That's hardly a
49.9.
Clearly, the Eurozone is still suffering a very long hangover from that sharp rise in energy prices. But tariffs don't seem to have had a disastrous effect on the Eurozone economy. It's early days. We'll need to see what happens, and particularly what happens with pharmaceuticals and so on. That's going to be really important for some European economies. But so far, so good, really, in terms of tariff impacts on the Eurozone.
What's the next big catalyst in your mind? Is it a potential peace talk with Russia and Ukraine, maybe denting the oil price and helping some of these German companies out? Or is it more on the trade deals? We still haven't had clarification on those pharma tariffs or on the semiconductor tariffs. What's on your mind as the next catalyst?
Yeah, well, not really Russia-Ukraine, to be honest. We don't think there's a really big risk premium priced into the oil price, and neither do we see big flows of gas resuming, even if there is a ceasefire from Russia to the Eurozone. The Eurozone has pulled back from that. There are clearly serious risks associated with relying on Russia for gas supply. So it's unlikely that you're going to see really major changes in commodity prices related to that. That said, we do expect the oil price to fall off a bit as OPEC Plus raises its production, so that should be something of a boost. And also we've got defence spending still coming through in Germany, which as that materialises, that should start to boost the economy somewhat. So those are the positives. The potential negative is those tariffs on pharmaceuticals, which we'll see what happens later.
So I'm bringing a story about the UK data this morning, and I'm going to quote from it. According to Alex Kerr, UK economist at Capital Economics, July's undershoot, quote, is not as good as it looks, and even if this undershoot persists, the Chancellor will probably need to raise taxes by 17 billion to 27 billion in the budget later this year. If the Chancellor raised taxes, it's hard to answer this question, but what are the implications? She's raised taxes before on unemployment. We've seen the effect. Yeah. She's changed the non-dom rules. We've seen the effect. If we further push up tax rates in the UK, is that growth negative?
Yes. Well, yes. Tax rates need to be negative for growth, really. But the alternative is to let this slippage continue, and then more than likely you get a reaction in bond markets, which again is going to be negative for growth. So the Chancellor's stuck between a rock and a hard place.
So negative for growth and negative for growth?
Yes.
So the outlook for the UK economy is quite negative, one should assume.
Yes. I think it is fairly negative given the fiscal position that we're in. We would expect some growth in the UK, and we should have the effects of previous rate cuts still coming through, more interest rate cuts.
How sensitive is the UK economy to rates at the moment?
Quite sensitive. The mortgage market is more sensitive than in the US or in Germany, for example. So that should do something to boost the economy, to support the housing market, but offset by this ongoing fiscal tightening, unfortunately.
Do you see what's happening in the UK as a real kind of doom loop scenario of what happens when government
I hadn't
debt
gone quite that
gets-
far. Doom
gets
loops. You're not
too
getting
big?
into doom loops.
What happens when government debt gets too big? And, you know, like what we had last week, we had better than expected GDP data, which is great for the chancellor, but then yields rose that ate into her headroom. I mean, she really can't win in this scenario. And in my mind, is there really any way out?
Well, growth really is absolutely the way out, and the hope that those
real growth, not nominal growth.
Real growth, absolutely, yeah. So the hope that those interest rate cuts do start to have an effect, that inflation starts to come down. I think that the real risk, well, a really big risk at the moment, is that the increase in taxes on employers and the increase in the minimum wage feed through further to wage growth and to inflation expectations, keep inflation high, then we can't get the rate cuts from the Bank of England that we're all hoping will continue, and that would be a real blow. But on the other hand, if those effects are temporary, if those interest rate cuts continue, then I think that should be really helpful, and that could
How are
be
you thinking about the division at the Bank of England?
It's
really
really
surprising, and you know, I mean, hardly any central bank has this kind of division, and the chair Bailey still exists in some way. Why is there no calls for Andrew Bailey to step down in order to try to get some sort of better clarity on where the Bank of England is going?
Well, you know, the reason that you have large committees is so that differences of opinion can be expressed, and it's very clear that things are unclear in the UK, that things are uncertain. On the one hand, you have these persistent price pressures, but the economy is really not faring well. So I think it's no surprise that there are divisions. It's really interesting that we had that second vote for the first time. It'll be interesting to see whether that happens again in future. But I don't think that this is really a sign that the bank is performing poorly. It's just a sign that there is a lot of uncertainty at the moment around the economic data, and I think we're going to continue to see these divisions.
It's Jay Powell. The title of Jackson Hole is all about the labour market and the transition. There is a view that maybe the hint there is that Jay Powell is going to transition to a new view on the labour market. Is that what you're expecting?
No, not really. I think it's very likely there will be more emphasis on the labour market, just given the data that we've seen.
Yep.
And we know that the Fed explicitly has this dual mandate where it needs to look at the labour market too. So and that, I think, will be emphasised. But on the other hand, the inflation risk, the stickiness of inflation, the recent rise in services inflation, which suggested that maybe when the Fed was worrying about the tariffs and goods prices, it had been looking in the wrong place. I think those are two sides of the coin, which Powell's going to need to express, and will need to walk a very careful line between not implying that the labour market downturn is by far the more important thing.
I do wonder if he's not overtly dovish, whether he's perceived as being hawkish.
Yeah,
that does seem to be the risk that maybe.
I think he might be. Yeah, he might be, and I think the greater likelihood is that the market movement is in that direction after his speech, in the hawkish direction, in my view, because I think he'll try to be very balanced.
Great to see you. Thanks for stopping by to see us. We really appreciate it. Jennifer
Okay, you're welcome.
Chief Global Economist, joining us from Capital Economics. Coming up, retail earnings in the spotlight. We've got disappointing sales. We got a disappointing sales outlook from Target yesterday. The big news, actually, in some ways, came in terms of senior management changes. We have Walmart coming up. That's the big one. We'll talk about it next. This is Bloomberg.
single best investment opportunity you see in the world, regardless of industry or geography. Why? And again, how are you making it available to your clients?
I think there's no question AI is going to impact everything we do. The opportunity to take great companies and use AI is going to transform. Also, the issue of jobs. What do we do with jobs? Because there's no question, you look at things that are customer service oriented, and the AI is so much more efficient. As we look at across all these different opportunities, what we really like is data centers in the U.S. And, the one thing that we know is that AI is just going to create this enormous demand for data and this even growing opportunity for cloud computing. So for us, owning data centers for 20, 30, 50 years, we're going to have a limitation on power in the U.S. There's no question over the next 20 years, the technology will change for chips. It'll become more competitive, and NVIDIA may not be the only major provider. So I think you're going to have a big technology refresh over the next 20 years. But the one thing we know is you're going to need data centers, you're going to need power, you're going to need cooling to support all this growth in the cloud. So we look at them as long-term bonds.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Welcome back. You're watching the opening trade. 45 minutes into the equity market session, and I have nothing to report. As you can see, equity markets are going nowhere in a hurry. We're waiting for the next catalyst. What will that catalyst be? Could it be what happens around the Ukrainian situation? Could it be what happens out in Jackson Hole? We will wait and we will watch, but we don't have any clarity on any of that subject now. It does so. The excitement, and I think where we are seeing some action this morning is in defence stocks, and I do feel that is a reaction to maybe actually the Russians pouring a lot of cold water on the idea that, A, we're going to see some sort of Zelensky-Putin meeting. And I think Zelensky is setting out some sort of criteria for that as well. So I think that feels like it's a more distant prospect. But also this idea of some sort of security force operating in Ukraine to provide guarantees for Ukraine appears to be further away now than maybe it was. And that feels like something that basically puts us back to where we were before. The status quo is maintained, the conflict continues, the ordnance being used at the moment that is being provided by the United States and Europe is going to continue to flow into that country. That in some ways is good for the defence companies that we see on our screens in front of us. Rheinmetall, BAE Systems, names like that, doing relatively well this morning.
Yeah, I think there's still a lot of questions to be answered on these security guarantees that Witkoff mentioned to the press on Sunday. And I think that you can kind of see that in the market reaction this week. I thought maybe we'd have some big surprise, big breakthrough, big drop in oil, big rise in the euro. And it's not something we necessarily got.
Definitely not getting that right now. It's interesting, actually, because the other thing that the Russians, Sergei Lavrov, has suggested over the last 24 hours is that maybe China would be involved in any kind of security guarantee for Ukraine. Now, this morning, the Ukrainian President, Volodymyr Zelensky, very much pushing back on the idea that China could be added as a security guarantor in terms of a ceasefire. Not actually, interesting enough, ruling out Russia, but I'm assuming that's that there's a sort of tacit read on that. Zelensky says he needs security guarantees only from those countries that are ready to help Ukraine. Does that rule out Russia? One would have to assume so. Joining us now is our Brussels bureau chief, Suzanne Lynch. Suzanne, where are we on this idea of a security guarantee? We heard Witkoff over the weekend talking about the fact that the Russians had accepted the idea. The Europeans have been running around trying to sort one out. And now you've got Lavrov basically saying, yeah, we want to be involved and the Chinese want to be involved. And you do wonder, therefore, whether any security guarantee is actually worth the paper it's written on. Where are we?
Yes, I mean, these statements by the Russian side, in one sense, are not a surprise that they were going to respond to this idea of a security guarantee in this kind of way. But it's obviously really a non-starter, the idea that Russia would be involved in dictating the terms of a security guarantee when they are the aggressor that these European allies are trying to protect Ukraine from. So that's one issue. Secondly, this issue of China being involved. This is an interesting point. There has been whispers of this over the last few years since this full-scale invasion of Ukraine by Russia. Russia and China, obviously, something of two allies when it comes to, for example, the UN Security Council when they meet there. But again, the idea of Chinese troops or Chinese presence in Europe, which is what this would mean in reality, is something I think that will be rejected by European allies. But of course, it's not just European allies, it's the United States too. They're also a member of NATO and they're part of these discussions. So, you know, there will be questions asked about how much traction this might get in Washington. But ultimately, no, here in Europe, what they're looking at and what they're trying to scramble to put in place is some kind of a system, NATO-light, that they would be there to try and help and back up Ukraine with the help, they hope, of some kind of US involvement.
All right, that was Bloomberg's Suzanne Lynch joining us from Brussels on the latest on Ukraine-Russia developments. Let's take a look at some other catalysts that we do have on the docket for you today. We do have some more global flash PMIs. The Eurozone numbers drop at 9. We also have the UK numbers at 9:30. And then later today, U.S. jobless claims. We also get Walmart earnings before the bell. And the Jackson Hole Symposium begins later today out in Wyoming.
Well, let's pick up on that retail story. Busy week. We always get it kind of towards the end of the earnings season. It's the retailers that come out, the big box retailers out of the United States. We've had a few already. We got a disappointing sales outlook from Target yesterday. Today, though, is the big one. Walmart is on deck, and Jennifer Creary is here to give us a sense of what we could learn. It's such a useful tell on what is happening, in retail, what's happening with the tariff story, what's happening with the U.S. economy. What are we going to learn? What should we expect to learn from Walmart today?
Yeah, so it's been a real mixed bag so far for retail earnings. So far, we've seen some of the stronger results. TJ Maxx, for example, performing very well. They raised their full-year earnings per share guidance, and that's thanks to its value proposition. So the lesson we can take away from that is that customers are really looking for value, so it's a good time to be a discount retailer. Perhaps some of the weaker results. So Target, for example, the big news coming out yesterday that it replaced its CEO, and that's in an effort to really turbocharge its turnaround. And it's having to manage some higher costs, as all retailers are, relating to tariffs. And so the big one today, Walmart, analysts are expecting a pretty positive read on it because of its really tight inventory management. And as you mentioned, it's seen as kind of a barometer for U.S. consumer sentiment. So that's one that investors will really be keeping an eye out for.
Jennifer, what have these results told us about how these companies and how consumers are dealing with the hit from tariffs?
Yeah, I mean, no retailer wants to raise their prices, but we're already seeing that bleed through. So Home Depot, for example, Target as well, saying that they'll potentially have to raise prices. Walmart as well warned in the previous quarter that they're going to have to raise prices on certain products, including baby products, for example. But we're also seeing evidence of some retailers trying to manage those costs, swallow those costs, either by negotiating lower prices with some of their suppliers, which Target mentioned in their results. And so it's a tricky time for retailers, but they're going to have to try and keep costs low because we know the customers are looking for value.
All right, that was Bloomberg's Jennifer Creary giving us an overview of these retail earnings that we've got this week. A bit of a mixed picture, but I like what she said there about some of these retailers warning that they'll have to raise prices in the future. No one actually saying that they've raised them already.
Yeah, but it's coming, and inflation's already inflation's ticking up, and we haven't raised prices yet. Is that
still beating through that inventory, I guess?
Yes.
But moving on to Jackson Hole, it kicks off today in Wyoming. Joining us now to discuss is Bloomberg's senior strategist, Neil Campling. Traders are still expecting this rate cut in September. Are we going to get that solidified by what we hear from Powell tomorrow?
I think the message from Powell tomorrow is going to be the same message that he's had before, which is trust the data, wait for the data. And I think that's going to be the ongoing message.
Doesn't sound very dovish to me.
I was about to say, this is the debate this morning, okay?
Absolutely.
So if it's not dovish, it's hawkish. Seems to be the tone. And if it's hawkish, then the market's not going to like it. Is that the kind of...
Well, and then we're going to get probably the social media post from somebody in the White House saying, too late, Powell again, aren't we? In one sense, I think traders, when talking to clients this morning, actually, I think the message back is that the short-term message is actually less important. The longer-term message is going to be, look, we've got at least 3 seats that are coming up, and we've probably got 11 candidates now, and it's a question of the most dovish of those candidates are probably going to likely find themselves in seats within the Fed.
If you're managing a P&L, though, right, are you worried about the long term, or are you worried about the short term?
Well, I suppose, if you look at what equity clients are talking about, they're saying that what we've seen so far is the huge kind of V-shaped recovery we saw since the April dip is an even shorter V-shape than we had after COVID.
Yeah. They get shorter and shorter.
They get shorter and shorter. And so now we're in a situation where you've got so many kind of mixed messages that are out there. There's also the question about, what do we see within the data itself?
So it'll be an I-shaped recovery. You can't actually tell the difference between. There's no gap between the two.
5 seconds of a dip.
We're going from months to weeks to days at this rate, to hours even perhaps.
But I have a question. Powell needs to change the way that he's characterized labor market. He characterized it previously as solid. Yeah. Do you think he's going to use that same language tomorrow? And if he doesn't, what else is he going to say? Is he going to sense that the labor market has weakened?
I mean, again, I think, and you've just been talking about retail earnings, for example, and the messages you're getting from the corporates, where we haven't seen it come through yet. And actually, we look at the PPI data. Again, we haven't seen it come through yet, as in they're not passing through the costs. So only two things can happen then, if you think about it slightly longer term. We either have to have margin compression, or we have to have job losses. So even if he takes out the word about the robust labour market, I think he's still going to say, look, core PCE, which is what they care about, is still hot.
It is still, it is. But here's the bit that I can't figure out, okay? It feels like the market wants a slowdown. And the market wants the labour market to weaken, so that Powell can say that it's weakened, so therefore we can get rate cuts.
Yeah, rate cuts, which is great for growth and is great for stocks. And
but isn't a bad labour market bad? Isn't that the kind of the concern?
No, we want it to weaken slightly, not fall off a cliff. But history does tell us that once the labour market starts to weaken,
that's my point.
It does
Careful
fall off
what
a
you
cliff.
wish for here. You want a labour market that's slowing, so Powell can cut rates.
But then they come in and do QE again, and everyone's happy.
Yeah, exactly.
We all know that playbook.
If the cut, and I don't think it will happen, but if the cut was 50 basis points rather than 25, what message does that send?
Yeah, exactly.
The data we haven't told you about yet is really bad. So what do you want? I mean, the other thing is, if we look back at the 2Q earnings season, it's quite clear that tech was the heavy lifter for the whole of the S&P earnings. If you go slightly down the market cap level, then we had near 9% earnings growth for small caps.
Yeah.
When we was expected to have a 3% decline. Now, small caps really, at the end of the day, are the lifeblood of the economy. So it's not showing up in that data yet either. So we've got so many mixed messages that, I think...
Which ones are you listening to?
Oh, I listen to all of them, obviously.
I mean, given the theme of Jackson Hole as a labor market in transition, and then it does discuss immigration within the subhead of that, I'm looking for a big update on what Powell thinks that immigration is going to have on the U.S. economy. Is it going to be a weaker labor market, or is it going to be weaker growth? How is he looking at it?
You can have an unemployment rate that's stable.
Exactly.
And a labour market that is producing 75,000 jobs a month. Yeah. That feels like stability to me.
It's not off a cliff, is it? We're not talking about a kind of COVID-type situation, or even with all the uncertainty around tariffs. And we've had some pretty worrying data again this week from some of the corporates, like Toll Brothers, James Hardie. The housing market's not great. Construction, retail numbers, etc. I mean, there's a lot of mixed messages.
A lot of things out there to listen to. Anyway, that wraps things up for us. The Pulse is coming up next. Enjoy the rest of the day. Friday's going to be a big day. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersetchi. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersetchi in Vienna, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Fed Governor Lisa Cook says she will not be bullied into stepping down after President Trump demanded her resignation over allegations of mortgage fraud. Tech stocks stabilize after a 2-day sell-off as markets tread cautiously ahead of Jerome Powell's Jackson Hole speech tomorrow. Plus, the US says Russia wants Ukrainian territory it does not yet control as Moscow pushes for a role in the security plan for Ukraine. Let's get you the latest data in terms of the PMI. We've had the numbers coming through from France and Germany, both stronger than expected and suggesting there is some resilience to this Eurozone economy. The numbers, though, of course, on the headline basis for both of those countries, or at least for France, still in contraction. The top lines coming through for the Eurozone area, August composite PMI rising to 51.1, above the forecast. It's a stronger number in terms of the latest composite PMI for the Eurozone, 51.1, firmly in expansionary territory on that metric then. So we watch the euro and we watch yields as we see the sovereign debt of Europe selling off, at least partially. Yields up around 2 basis points the last time I checked. Euro, of course, reflecting a little bit more upside in terms of the relative resilience of a Eurozone economy, of course, has struck that deal on 15% tariffs with the US. Euro at 116 then, marginally higher, but you did see some dollar strength earlier in the session. That is starting to fade. 470 right now on the UK gilt. We had some borrowing numbers that came through for the month of July that look slightly better for the Chancellor than had been expected. A move there of close to 3 basis points. The benchmark 10-year yielding 430 as we lead up, of course, to Jackson Hole and Jay Powell's speech on Friday out of Wyoming, and Brent at $67 a barrel. Oil prices higher by 0.6, and that is leading energy as a sector, one of the key gainers. Let's have a look at the map to see things are shaking out across the picture then, with the FTSE 100, of course, yesterday notching another record, the 24th record high for the FTSE 100 yesterday. Today, you are flat here in the UK. The CAC is off by 0.2% over in France. The FTSE MIB in Italy faring slightly better, with positivity and green on the screen over in Italy, up 0.4%. The DAX over in Germany is flat. These markets looking for that next catalyst, and will it be Jay Powell? We begin the show and the analysis right now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in for Francine Lacqua in London. Now, Federal Reserve Governor Lisa Cook says she will not be bullied into stepping down from the central bank. This after President Trump called for her resignation over allegations of mortgage fraud. Federal Housing Finance Agency Director Bill Pult says Trump has cause to fire Cook.
She lied, in my view, in her statement tonight because she said that the first time she heard about it was through my tweet. She didn't hear about it from my tweet. There's no way. She doesn't follow me on Twitter. I think this lady is a professional liar. She shouldn't be at the Federal Reserve. She's going to resign, in my view, and if she doesn't resign, I do believe that the president has cause to fire her, and that will be up to the president whether he decides to do that or not.
Important to note, of course, that no charges have been filed against Lisa Cook. Let's bring in Bloomberg's chief Asia correspondent, Ros Mattson, now for the details on a Lisa Cook who is now in the firing line of this Trump administration. What is being alleged? How has she responded? How significant is this potentially?
Well, it is significant because it's the latest salvo by this administration against the Fed, chipping away at the Fed over time. Obviously, Jerome Powell, but now also Lisa Cook, and it's the White House, but it's also the Federal Housing Finance Agency, which is coming heavily for her, as you just heard. And the accusation seems to be that she was essentially juggling mortgages for primary residences. So you've got more than one on the go around the same time. They're overlapping, and it's not a completely uncommon practice, but obviously it's very much into a grey area, and that's the accusation that's been levelled against her. Obviously, she's denied this and says she stands ready to defend herself. But it's interesting because there's also the accusation that the administration has levelled at some other people who they're having disagreements with. So some politicians, including leaders in certain states, they put these allegations against other people too, saying you're accused of mortgage fraud. So it's not something that's completely out of the playbook for this administration. I mean, she's obviously come out again and said very strongly that she's going to defend herself. But the overarching message here is that this is an administration that's not going to stop coming for the Fed either way. This is an administration that wants to rework and rebuild the Federal Reserve. So how should we be thinking about this accusation in that context? Well, that's right. So obviously, if they can loosen up another vacancy on the Fed, that enables this administration to rebuild the Fed in their own image, in a way, perhaps with some more like-minded individuals. And they've got quite a few balls in the air on that already. I mean, you've got the point where Jerome Powell's term will end. They've kind of stopped the idea of firing him or the possibility of trying to do so, but they're not stopping criticising him either way. And we've got, of course, the temporary replacement at the moment for Adriana Kugler, Stephen Moran, who's in until January, and that gives them time to map out who they would put in properly for that vacancy potentially. And there's a lot of names in the air from within the administration, but also within the Fed itself, and perhaps some Fed officials who they see as more conducive to Donald Trump's thinking, especially on interest rates. But what it could do is enable them to build the Fed into something that they want to some extent. That raises further questions about the independence of the Federal Reserve. And you see that in institutions across America. It's not just the central bank, but it's looking at courts and other important parts of the machinery for the US. And are they, looking to put in people who would be more conducive to their own thinking? Okay, Ros Mattson, thank you very much indeed, overseeing our coverage, of course, out of Asia here in London for today, at least with that context. Ros, thank you. Meanwhile, US megacaps dragging down the NASDAQ despite a bounce off session lows. We did see a bit of dip buying towards the end of the session yesterday, it seems. Markets are in something of a wait-and-see mode ahead of the Federal Reserve's Jackson Hole meeting. Joining me now is Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management. Karen, good morning. Thank you for joining us. Is Jay Powell the next catalyst for these markets?
Quite possibly. I mean, I think the market is expecting Jay Powell to do a continual good job, as he has been doing, of getting the balance right, of making absolutely clear that what's going on in the background is noise. They are an independent central bank. They will set policy according to what's happening in the policy in the economy. But he's in his safe space. He's got his fellow central bankers around him. And the topic of the conference is the labour market. And I think really laying out that, yes, demand is weakening for labour in the US economy, but there's an awful lot also that's happening on the supply side because of migration, and therefore the outlook for inflation and second round pressures, should we get a bump in headline inflation, which seems very likely after the tariffs, I think that would get markets pretty concerned about the current pricing, because that's the part of markets at the moment that concerns me. There's a lot of rate cuts for the Fed price. We've still got over 100 basis points in the coming year. That doesn't sit with how I see the outlook for the US economy.
The market pricing, the markets are over their skis in terms of price. Are they over their skis in terms of pricing September?
I think quite possibly. I mean, all it's going to take is a bit of stickiness in inflation and actually a labour market print which shows it's not falling off a cliff for the market to say, hang on, maybe actually this isn't going to be a particularly preemptive Fed. And for markets, that's what's really important. Markets love preemptive central banks, not reactive central banks, because, of course, when they're then reactive, usually downturns have already gathered momentum. So, yeah, I think it could be a really important meeting.
Do you worry about Fed independence?
Yeah, I mean, I was sitting listening to Rosalind speaking just then, and all that was going through the back of my mind was dollar, dollar, dollar. You know, everything we're talking about here, all of these checks and balances on the US system is all what underpins its reserve currency status. Everything that underpins why global investors have for the last 20 years wanted to park their money in US assets. And the Federal Reserve is absolutely central to that. So picking away at global investors' perceptions of whether the Fed can safeguard, preserve that value of the dollar, you know, we have to be very mindful of that. So I think as investors, even if what transpires over the next few years ends up in a Federal Reserve more willing to cut short rates, what we need to be thinking about is what's happening to the long end and what's happening to the dollar. Because particularly us outside of the US investing, that's where any perception that this is not appropriate policy is going to show up.
And as you were thinking about the dollar, I was thinking about Hungary, I was thinking about Turkey, I was thinking about how those institutions were remoulded in the likes of Erdogan and Orban over in Hungary. When we think about how that ties in then to the rotation trade out of US equities into Europe, that had been such a front and centre trade earlier in the year. It seems to have faded on the back of strong earnings out of the US, particularly with tech.
Yeah.
Does that come? Where are we in that story?
I still think we're at the beginning. I mean, if I look at valuations, to me it still suggests that, you know, there's still a lot of pessimism about Europe generally. Although the valuation discount has closed slightly, it's still beyond what's normal. And so I think that relative optimism about the US, pessimism about the Europe is still there. So when I think about how we then move forward, it's coming from both sides, from my perspective. In the US, tech is an important, as you say, an important component of the story. I'm still a little bit nervous that we haven't really gone through the real tech test yet. You know, these companies are investing massively in these new technologies, but the question is, how much are they going to be in demand and at what price in the broader economy? It's quite rare historically to see a capex downturn because of uncertainty and tech earnings not decline. So I'm a little bit, there's a few risks around that. And then on the Europe story, you know, we've just seen the composite PMI this morning. I think we're just at the beginning of Europe's recovery. We haven't yet seen the German fiscal money hit the economy yet. The consumer's just waking up to lower interest rates. They've got all those savings that they can go out and spend. So I think the growth differential is going to look increasingly appealing. And, you know, after a decade of Europe underperforming, there's still a lot of skepticism and there's still a lot of money to move.
How do you explain then, I mean, you've touched on this partly, but in terms of the moves that we've seen into equities in Europe and what's really driven the growth in the upside that we've seen year to date has been value stocks and small caps. And in the US, it's been growth.
Yeah.
Is this a hedge by investors? Is it two different groups of investors? How do we make sense of that kind of split view on the stock story regionally?
Well, I think in Europe, so as you say, value and small cap. The small cap is interest rates have come down. We know small cap is pretty interest rate sensitive. Interest rates have halved in Europe. That small cap space is responding. And Europe's small cap is often an exciting area of the market. So that's been revitalized. And value is all part of just this reassessment that maybe Europe isn't stuck in the rut that it's been in the last decade. Maybe actually this confrontation from Russia and from Trump is actually galvanizing the region into some good policy, and maybe we're discounting some of those sectors too heavily. And then, you know, tech, as I've already explained, on the US side, we're going to see. I'm not pessimistic on tech. I just think there's a very high expectations on quite how easy the transition from investing to selling the product's going to be. And usually, historically, it's never a straight line.
Yeah, MIT coming out with a survey and some data suggesting that the ROI is still a piece that is missing in terms of investments around AI and adoption by around businesses and by businesses. The FTSE 100, a fresh record yesterday, and part of that seems to be because the FTSE 100 doesn't have a lot of exposure to chips or to AI. Is there further to run, do you think, for UK big cap stocks and the FTSE 100, or is it looking a little stretched at this point?
Well, we know that the UK benchmark is heavily weighted towards energy and mining. So energy, partly because of political factors, but actually partly just the AI story itself. You know, we know these technologies are incredibly energy hungry. That's underpinning energy prices. We've seen that uplift. So the FTSE tends to go with it. I mean, it's one of the things we've said is that when you're thinking about hedging yourselves from some commodity risk or from some inflation risk, actually the UK benchmark is a pretty good place to be. I mean, if you go back to 2022, when most markets were down because they were worried about inflation, the UK benchmark was one of them that was up. So I think it's part of that inflation narrative where actually the UK market will give you a bit of resilience.
Okay, Karen Ward, thank you very much indeed. JP Morgan Asset Management, EMEA Chief Market Strategist. Investors should be ready in portfolios to that point for inflation surprises, and the rotation from US to European equities has further to run. Coming up, Russia demands a role in the security plan for Ukraine and says China needs to be involved too. Details are next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything. This week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance, Friday at 9 a.m.
The conversations matter, the insights you need. This is The Pulse. I'm Tom McKenzie in London. So, US Vice President J.D. Vance says negotiations over ending Russia's war in Ukraine are focused on security guarantees for Ukraine and territory that Russia wants to control. Speaking to Fox News, Vance added that this would include Ukrainian territory that Russia is not, at this point, occupying.
And we've made a lot of progress, Laura. Look, who knows what's going to happen? The president tells me this all the time. You can never say with certainty what the outcome in this situation is going to be. But we now have the Russians talking to the Ukrainians. They're talking details about what would be necessary on each side to stop the fighting and stop the killing. We've made more progress in 3 months than the country had made in 3 years in stopping this conflict. And I think it's because sometimes you just need a president who will pick up the phone and call somebody.
Well, for more, Tony Halpin, who leads our Russia economy and government coverage, joins me. Tony, what sort of guarantees, in terms of security guarantees, are being considered for Ukraine and potentially Russia's own involvement in those security guarantees?
Yeah, so Vice President Vance's comments there just illustrate some of the difficulties because while he mentioned it in terms of security guarantees and territory, for Ukraine, some of the territory that Russia wants is critical to their defense. So it's not as simple as two separate issues. Russia is also clouding the horizon somewhat by talking about the need to be involved in any security arrangements for Ukraine and also potentially involving China as one of the United Nations permanent 5 powers. European powers on top of that are also trying to forge some kind of NATO-light agreement that would set out what kind of security defense provision they would make in the event that Ukraine gets attacked in the future. So there's a very complicated picture, lots of moving parts.
Tony, it's quite remarkable on some levels to consider that Russia is suggesting that it has a role in a security guarantee which would involve securing Ukraine against, ultimately, Russian aggression. Is what we've been hearing from the Russian foreign minister, Sergei Lavrov, is this an attempt by Russia to pour cold water on the modest optimism that has come out since this meeting in the White House?
Yes, in some ways it is. It's just to underline the difficulty, really, of trying to come to a solution to this war. But it's also part of how Russia views the conflict. In many ways, they don't view it simply as a confrontation with Ukraine, a conflict and a war with Ukraine. Putin has always viewed it in many ways as a confrontation between Russia and the West, which is taking place in Ukraine. So Russia is trying to use this moment to establish some sort of broader security architecture in which it would have a role and Ukraine's security would form part of that security architecture. But that's very difficult to argue for when you're the one that's actually committing the invasion and committing the aggression, because Ukraine wants to be sure that it will be protected in future just against Russian aggression. So it's all part of a rather complicated chess game between the Kremlin and the White House and NATO on one side, with Ukraine in the middle.
And Tony, are we any closer to this much touted meeting between Putin and Zelensky?
Well, Zelensky said yesterday he's willing to meet Putin, though he won't see him in Moscow, and cast doubt on places like Budapest. He said it should be in neutral Europe. Putin's given no sign yet that he's ready to meet Zelensky. He's always said that he will do, but they have to have an agreement on the table, and they're very far from that right now.
Okay, Tony Halpin, who leads our Russia economy and government coverage. Tony, thank you for that update. To Israel now, which is reported to have approved new settlements in the occupied West Bank, while its troops have now reached the outskirts of Gaza City. The Israeli military called up around 60,000 more reserve soldiers to join the war against Hamas, a sign that preparations are underway for a stepped-up offensive, despite ongoing talks about a ceasefire. And in technology, Microsoft is limiting Chinese companies' access to early warnings about flaws in its technology. The company has been investigating whether a leak led to vulnerabilities in its SharePoint software being exploited. Microsoft has blamed state-sponsored actors in China for a series of SharePoint hacks that affected hundreds of government agencies. And it's another busy week of earnings stateside with retail stocks in the spotlight. We got a disappointing sales outlook from Target yesterday. Today, up front and center is Walmart. Up on deck, of course, the biggest retailer, at least the biggest grocer in the US. For more, let's bring in Bloomberg's Jennifer Creary for what to expect and what the earnings so far has told us about the health of the consumer and what's happening in terms of the retail space in the US. What are we learning so far about this sector, and whether or not there is resilience amongst the US consumer, where we're starting to get question marks about the labour market and maybe a little bit of softening?
Yeah, from these retail earnings, we're really seeing some of the holes in some of these retailers' business models. I think if we were to take one message from the US retail earnings so far, it's that it's a good time to be a discount retailer. Customers are really shopping around for value. So some of the winners so far, TJ Maxx, for example, raising their full year earnings per share guidance, and that's thanks to its value proposition. On the negative side, there's Target. You know, big news coming out yesterday that it's replacing its CEO as it's really trying to turbocharge its turnaround. And, you know, it's having some difficulty with tariff-induced kind of price rises, and it's going to have to weather those storms. Now, looking ahead to Walmart, it's seen as slightly more resilient. It's probably able to weather some of those storms a bit better than its rivals. So analysts have a pretty positive read on the retailer so far.
Okay, maybe a bit more resilience amongst the Walmart numbers that we will get later today. You touched on tariffs. What is our broader understanding of the tariff impact? There was a reluctance after April for companies to pass on higher prices. Maybe there was a political play there. We were concerned about being targeted by President Trump. Is that starting to change? Are prices going up? Are tariffs starting to have an impact?
Yeah, I mean, all retailers are very cautious to say much about tariffs at the moment. Of course, they don't want to spook investors. But we can point to a few so far. So Estee Lauder, for example, highlighting a $100 million hit to profitability from tariffs. We're seeing some retailers already raise prices. Walmart in Q1, for example, raising some prices on certain products, including baby products. Target as well in their earnings saying that they'll have to negotiate lower prices with suppliers. So they're really having to try and manage those costs before passing them on to the consumer. So we're seeing different ways. So TJ Maxx, for example, as well. They're an interesting case because they're a bit more shielded. Their business model means that they buy kind of excess inventory from other businesses, and so a lot of those fees are already covered by those businesses. So we're really seeing the differences in how retailers are shouldering some of those costs now.
Jennifer, excellent. Thank you very much indeed. Really great setup in terms of what to think about with the Walmart earnings up front and what we've learned already from the likes of Target. Jennifer Creary with that update and preview. Thank you. Meanwhile, to the auto sector, Ford is looking to develop a supercar for off-road racing as a follow-up to its new $325,000 Mustang GTD sports car. The CEO, Jim Farley, says he sees the vehicle as a dirt-loving, high-performance machine that could compete in the Dakar Rally.
I'm very interested in that. The off-road, the on-road performance hierarchy is very simple to see, and the very top is overserved, in my opinion. But no one's ever done this off-road supercar.
And after a months-long hiring spree, Meta says it has paused some hiring while it does, quote, planning and forecasting. The move comes as part of its latest restructuring of its artificial intelligence division, which will now be split into 4 distinct teams to better capitalize on new talent. And OpenAI says it could eventually offer a service whereby it helps other businesses to tap into the data centers and physical infrastructure needed for AI. The service could help offset some of the company's immense costs and would be loosely based on the success Amazon had in renting out its spare cloud computing capacity. Success, of course, Amazon continues to see. Let's check in on the markets then as we lead up, of course, to really the market-moving set piece of the week, which is Jackson Hole and Jay Powell's speech, of course, tomorrow on Friday. European stocks across the benchmark a little softer by 0.1%. The DAX over in Germany dropping 5 points. Over in France, slightly heavier selling, down 0.3% on the CAC 40. And the FTSE 100 after a 24th record close yesterday, year to date. Further upside in the session today for UK stocks, up just 0.1%. US futures, let's check in after there was a bit of dip buying for some of the tech names yesterday. S&P futures flat, NASDAQ 100 futures pointing higher by 0.1%. Coming up, we'll focus on the UK and Chancellor Rachel Reeves. Stay with us. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Good morning, welcome to The Pulse. I'm Tom McKenzie in for Francine Lacroix in London. These are your top stories. Happy Thursday. Fed Governor Lisa Cook says she will not be bullied into stepping down after President Trump demanded her resignation over allegations of mortgage fraud. Tech stocks stabilize after a two-day sell-off as markets tread cautiously ahead of Jerome Powell's Jackson Hole speech tomorrow. Plus, the US says Russia wants Ukrainian territory it does not yet control as Moscow pushes for a role in the security plan for Ukraine. Let's check in on gilts right now as we look as well, crossing the terminal right now, the red head on terms of the data around services and composite PMI out of the UK. August services PMI rising to 53.6. That's a pretty strong number. The forecasts have been for 51.8. So the services PMI data convincingly in expansionary territory. Composite PMI for the UK coming at 53. The forecast had been for 51.6. This, of course, on the back of the latest GDP data that we got a couple of weeks ago that suggested slightly more strength in the UK economy than some had expected. The gilt markets then, currently you're seeing yields up 2 basis points across the curve. The front end, the 2-year is yielding 3.94. The 10-year at 4.69. So very modest selling pressure. You're seeing that reflected, by the way, in the sovereign debt of France and Germany as well on the back of slightly better PMI data there. So it's not just the UK where you're seeing a bit of selling when it comes to sovereign debt, but you're seeing yields up around 2 basis points with the front end at 3.94. Now, the UK Chancellor will be heading into the autumn once again on the fiscal ropes. We've said that before, haven't we? Bloomberg understands Rachel Reeves is weighing a tax on high-value family homes at the point of sale to plug a £10 billion budget hole. That's just for 1 year. Bloomberg's John Stepek joins me now in terms of what we should be thinking about. So, John, you follow this very closely. What kind of taxes, what kind of changes should we be braced for then?
Well, I think, this is interesting because this is classic August news stories. There's a lot of kite flying going on at the moment, which is worrying for other reasons. But on Monday, we got a report that the Chancellor was looking at reforming stamp duty and council tax and replacing them with a kind of annual property tax that would basically be like a seller's tax. In some ways, that's actually a good idea, but it's extremely complicated and quite easy to mess up. And it appears the Treasury sort of pushed back against that. And then on Tuesday, we were hearing that actually what they were looking at was, at the moment, if you own a home and you live in it, then you get an exemption when you sell it from capital gains tax. And what they were looking at was scrapping that exemption on people with houses worth more than 1.5 million. So when you sell your $1.5 million or plus house, you'd be liable to capital gains tax on that. Now, it sounds like an easy way to raise money And you can also turn it, it's a mansion tax, it's a tax on the rich. You know, you're not kind of talking about inflicting pain on working people, but it's actually is rife with potential for disaster. Because the first thing that will happen if capital gains tax is imposed on houses of this value is that the Tories in Reform will turn around and say, come 2029, we're scrapping this. So no one will sell their house because, you know, why would you? Whenever you can avoid the capital gains on it simply by waiting. So I don't think any of these proposals will fly. And if they do, I don't think they'll raise the kind of money that they hope they will.
So what are the other options, John? What are the other options? What else? What are the other levers that this Chancellor could reach for? She's going to have to do something.
Well, she has to do something. But this is the problem. She's kind of ruled out all of the things that would actually move the needle easily. I mean, this is the real problem. The real problem with this is that she's ruled out raising income tax, national insurance, VAT and corporation tax, and between them they account for basically 75% of the UK's tax take. So that leaves you with 25% of somewhat more random taxes and tax reliefs. But if you mess about with any of those, then everyone's financial planning is completely messed up. So we already had messing about with inheritance tax at the last budget. We have constant rumours, and we have done for decades actually, that pension relief is going to be changed in some way. But as soon as you pull, it's a bit like the kind of reform in property tax issue. As soon as you pull on any of the threads of that, it suddenly becomes incredibly complicated. And at best, you could launch maybe a review or a report at the budget into how you're going to do this properly. And I mean, that might be a good idea. I mean, certainly, stamp duty is a terrible tax. It should be replaced. It could make the property market much more efficient if they get rid of it. But doing what they're thinking about doing just now would just be a disaster. It would grind the market to a halt. And it's already not doing brilliantly.
Yeah.
So yeah, I mean, there's lots of things she can look at, but I think the problem is because she's boxed herself in. In an ideal world, she would just reverse the national insurance cuts that the Tories made at the end of their term, which were kind of clearly a bear trap for Labour to fall into. Well, unfortunately, that is exactly, they have fallen into it. I mean, the other option is she could look at the fiscal rule. The fiscal rule is kind of made up. As long as you have a good story to tell markets about why you've decided it's no longer tenable, then I don't think the gilts market would throw a wobbly.
No, I mean, that's what the left-wing members of the Labour Party are pushing for, isn't it?
Yeah, I mean, well, the problem is you've got to tell a good story, and they wouldn't. You know, so it's like you got to kind of make people understand that we aren't throwing this aside because we don't want to meet it. We're throwing it aside because it's too restrictive at the moment, and we're going to make considered reforms that are going to promote growth while cutting the debt. But yeah, you're right. I mean, if they actually just said, no, we're not doing it, and then just, kind of decide to spend a load of money and putting up doctors' salaries or something like that, the gilts market would be less keen on that.
Okay. John Stepek, fantastic. Thank you very much indeed on the tightrope, of course, that this Chancellor has to walk, and the unenviable options as well. John Stepek is, of course, the author of Bloomberg's Money Distilled newsletter. You can get it on Bloomberg.com and, of course, on the terminal. Do read that. Now, the UK government, staying with the UK, is preparing to take control of tycoon Sanjeev Gupta's steelworks should they fall into liquidation. Lawyers for a creditor to Speciality Steel UK, part of the Liberty Steel Group, told a London court that government officials were preparing to appoint special managers in the event that the steel operations are wound up. It would be the second time that the government has intervened in the steel industry after it took over the British steel plant in Scunthorpe earlier this year. Does loyalty pay? If you ask a member of Gen Z, the answer is probably not. According to a new survey conducted by Intuit Credit Karma for Bloomberg, many young people have multiple current accounts to manage their money these days. Wait, did we need a survey for that? Let's get more from Bloomberg's senior digital finance editor, Ana Herrera. I'm being flippant, of course, but I could do an unscientific poll of younger friends of mine, and they all have 3, 4, 5 different bank accounts. Why is this, Anna, why is this potentially a problem, particularly for the incumbent banks?
So banks spend so much money in acquiring customers, and even more now that you have so much choice, right? But traditionally, you make more money from customers when they age and when you're able to sell them more profitable services like loans, right? So if they're not sticking around, they never get to the threshold where they're making you money. And that's becoming more of a concern with Gen Z because we spoke to someone who'd made £2,800 just opening bank accounts from like incentives, and he had over a dozen accounts.
£2,800 just by opening bank accounts.
Yeah, and he had a dozen bank accounts, right? And he was saying loyalty doesn't pay off, and he has a TikTok account where he's teaching other Gen Zers how to make money from incentives. So it is starting to become a little bit of a challenge for both fintech banks and also the bigger banks.
So how is the industry responding?
They are launching more incentives, which I guess, and also ones where they pay you if you stick around. So an annual incentive if you're staying for a year, for example.
You get paid for being a customer. Because still in the US, sometimes when you open an account, you have to pay for that account. But here in the UK now, you're being paid.
Yeah, exactly. Or if you're referring friends, because we saw Gen Z actually is more inclined to join a bank if they have a friend referral. And some others are just leaning in. They're saying, you know what, we can't get them to stick around on one app. Let's open multiple apps because they like ease of use. And so we'll just lean into it. Or we'll let them stay in our ecosystem, but, get services from other people.
What are some of the craziest promotions that you've come across?
Yeah, we spoke to Nationwide, and they took over a fried chicken shop in Shoreditch last year, and they got in influencers, and they were paying food delivery bonuses. So they gave around £200, I think it was, to spend on food delivery.
Yeah, so when I asked about crazy, I did not expect your answer to involve Nationwide. I don't usually associate Nationwide with crazy and chicken shops in Shoreditch, but there you go. This is what's happening as they try to respond. Anna, thank you very much indeed. That reporting course on the terminal and on Bloomberg.com. Bloomberg Senior Digital Finance Editor on the lack of loyalty amongst Gen Z. Anna Herrera, thank you. Now, we are going to switch focus, talking about wealth, but of a slightly different scale, because Africa's richest person, Aliko Dangote, has built a $20 billion oil refinery in Nigeria, bigger than any in Europe. But critics are questioning whether his dominance will truly benefit the nation or mainly just enrich himself as he seeks to ban foreign competition. Joining us now for more on Bloomberg's Big Take is Jennifer Dabasaja, who's across this story for us. Jen, who is Dangote? How did he become so wealthy, and why is this refinery so important to Dangote and potentially Nigeria itself?
Right, Tom. Dangote, for many people, stirs a bunch of different emotions. But if you take a look at what he's actually been doing over the past few decades, he made his first billions in his cement business, but his family has been in the commodity space for a number of years. He's traded things like cocoa and other cocoa, cotton, cashew nuts, and even sesame seeds. But really, the focus over the past few years has been on this oil refinery that you were just speaking about. And the reason is a bit twofold. If you take a look at Nigeria, it is Africa's biggest oil producer. It's also the most populous OPEC nation, and yet it has spent the bulk of the past few years and decades having to export crude to Europe and other places, and then import it back as a refined product. That has cost the government billions of dollars. Not just that, it's also been a drag on the economy because of the subsidies and also corruption. And so the fact that now there is this refinery in the country has been very significant for this administration. And of course, Dangote, you mentioned it's $20 billion. It took him nearly 11 years to actually get this up and running. And as our Bloomberg Big Take really digs into, this is for the first time in 3 decades, we're going to be seeing Nigeria being able to export refined products in a way that they haven't been able to do before. So many people, as you were just mentioning there, critics are wondering, though, whether or not this is going to be a lasting change for this economy and whether or not oil sales are really going to be a boost for the Nigerian economy, or whether or not it's just going to keep making Dangote even more wealthy than he actually is. And just to give you a bit of stats, in the past 3 months, his wealth has gone up $1 billion to $28 billion. And so this is, of course, adding to the empire he already had, but still affecting one of the most populous OPEC producer.
Yeah, of course. I mean, certainly, and the changes are there, and he's made this commitment, this investment. What is next then? What is next? The next step? What is the future looking like for Dangote himself?
there's still a lot that this refinery needs to do in order to get the maximum capacity that Dangote sees and even that local producers are hoping to see. And so there's still quite a bit that we're waiting for in terms of this refinery. For Dangote himself, we did recently hear that, I was mentioning earlier, that the first bit of his billions in wealth did come from his cement business. He recently announced that he was going to be retiring from the chairmanship role. And instead, they're appointing a former executive of EcoBank to be the chair of Dangote Cement. But Dangote's empire, as I was mentioning, doesn't just stop there. He's been in the commodity business for his whole entire life. He now sees fertilizers potentially being the next boon for the Nigerian economy. He also is looking at a deep seaport for Nigeria. And so this is not the last of Dangote, this refinery. And as he says to us, he wants Africa to be industrialized and be able to produce and export their goods and get the value add that many leaders talk about day in, day out.
Okay, well, that ambition is still there, isn't it, for Dangote? Jennifer Zabasaja in Johannesburg. Yeah. Thank you. You can catch more, of course, of Jen in the next edition of Next Africa. That is on Friday. Coming up to the earnings story, and this time, shares of Novonesis slumping, one of the biggest losers in the session so far. That's after the company trims its revenue forecast. Margins not as punchy in terms of the outlook as some had hoped for. I'm going to be speaking to the CEO next. This is Bloomberg.
Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Oaktree Capital's co-chairman Howard Marks is warning US stocks appear to be in the early days of a bubble. Marks spoke exclusively with us about his concerns over rising valuations and investor complacency.
This is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And the outstanding reason, I think, is that there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen. Whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we're probably in the early days of that.
When you talk about liking, Howard, maybe liking these assets a little bit too much, can you put into perspective the last time you saw this type of environment that left you thinking maybe some of the opportunities aren't as great when it comes to buying some of these assets at current valuations? Is there another time that this sort of reminds you of in any capacity?
Well, I guess, Lisa, the last time was probably around 97, when the market was kind of falling in love with tech stocks, and the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet, Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. Remember I said we're in the early days.
Oaktree Capital co-chairman Howard Marks speaking exclusively to Bloomberg. Back to the earnings story now. Novonesis shares slumping today. The biosolutions company that produces enzymes, proteins, and pharmaceutical ingredients reported earnings earlier. Analysts say a profitability miss and merely reiterated margin guidance disappointed. Joining me now to discuss the news behind the numbers is Esther Baijet, CEO of Novonesis. Esther, thank you for joining us this morning. The stock is now down 6.6%. It seems to be margins, and the forecast around margins is where some of this disappointment lies. You're projecting margins for the longer term by 2030 of 39%. Some of the markets expected 40% or more. Why couldn't you meet those expectations?
Thank you very much for inviting us today. We're very pleased with the results we delivered in the first half, with 9% revenue growth and profitable revenue growth. Also maintaining the EBITDA guidance for the year, including the headwinds we're seeing from currency. So upgrading the revenue growth for the year and then maintaining the EBITDA margin for the year guidance, including the strong headwinds we're seeing from currency. To your second part of the question on the guidance for the long term, we are a growth company, and that's exactly what we're committing to: profitable growth. 6 to 9% growth while expanding profitability from a very strong base from 37 to 38 EBITDA margin. We feel very pleased of where we are. We feel very comfortable of the strong foundation in place, and we're going to continue to build on a success formula of growth. Be close to our customers, be there with innovation, continue to invest with resources to be the partner of growth for our customers, and deliver on this beautiful 6 to 9% profitable growth, a 6 to 9% that we're committing to.
Okay, that beautiful 6 to 9% by 2030. Esther, how would you characterize that? How would you frame that? Is that a conservative outlook?
I think it's quite a strong outlook, 6 to 9% at 39% EBITDA margin at the end. 6 to 9% CAGR through the period, and at the end of the strategic period, 39% EBITDA margin. We're talking here about bringing solutions that transform the way that we produce and the goods that we consume. We're talking here about solutions that enable high protein content without compromising taste, texture, palatability, nor cost. We're talking solutions that enable cleaner label. We're talking solutions that allow high efficiencies, higher yields, less microplastics, new building blocks on how the fuels that we use and the energy that we consume. Those are the categories that we in, and those are the categories that we continue to invest to deliver on that 6 to 9% and also margin expansion through the strategic period.
At a time, of course, where we have tariffs and we have 15% on the Eurozone agreed in that deal with the US. What is the tariff, Esther, what is the tariff impact on the business now and into the future?
That's an amazing question, because that implying that you know what is going to be the tariff situation in the future. So I'm going to base and frame my answer on today. We do live in the same world that you do. We foresee forecast a neutral net no impact of tariffs for 2025. We are exposed to tariff marginally. Most of what we produce, what we sell in US, it's produced in US. And then the areas that we're not, we will bring mitigation efforts through optimizing extremely global and resilient footprint, while also through pricing through our customers. Through net impact from tariffs in 2025, it's margin, it's none. It's neutral and none. Then it is true that this could cause impact on the consumer behavior. And that's the reality that we live. We see some slowdown in household care. We see also some softness in beverages, but at the same time, we continue to see extraordinary pull on the growing demand for solutions for cleaner labor, higher yields, higher efficiency, muscle weight, advanced protein solutions that complement the way that we eat, and to bring solutions to the consumers.
And you updated your strategy today, Esther. To what extent will M&A play a role in that strategy?
The 6 to 9%, it's organic growth. So we're committing to what we are going to deliver on what we have today by continuing to invest on whom we are and by continuing to be closer to the customers. We are a biosolutions powerhouse. We bring biological-based solutions to respond to our customer needs of today and the future. And always we are going to be explorer and open to options in the market that could build up and expand and boost our performance and drive a value-added accretion for our shareholders, while making us also even a stronger partner of growth for our customers.
Okay, you describe yourselves as that powerhouse. Some of your competitors have come out as well. They've given their guidance. Esther, do you think if we take a step back, do you think growth for the industry is normalizing?
Yeah, I mean, we bear in mind that we play in the same markets that they grow 1 to 2%, and we're putting a guidance to 6 to 9%. So we are always outgrowing the markets that we present, and we're being that by doing that by being closer to the customers and by bringing them more portion of the answers of the future that they grow faster. You cannot make low sugar added with cheaper sugar. You cannot make low salt with more competitive sugar. You cannot make no microplastics with cheaper microplastics. So this is why we're growing faster of the markets that we play in. We see a little bit of a slowdown, as I mentioned, in household care, particularly in North America. We're watching that very closely, but that's also embedded within the guidance and also on what we see for the strategic period and how we're seeing the normalized growth of household care moving forward.
Esther Baiget, CEO of Novonesis, on the back of those earnings and those results and those targets into 2030, of course, 6 to 9% in terms of organic sales growth. Esther, thank you very much indeed for your time. Let's stay on the corporate news story in a redhead crossing right now. We've been talking about deal making there. This time it's deal making in terms of the finance space. Mediobanca investors rejecting Banca Generali's bids in a blow to the CEO. Mediobanca investors rejecting Banca Generali's bids. They're saying that the offer on Banca Generali has lapsed. That is according to Mediobanca. This is a story we'll keep across for you, the pricing reaction to that.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest.
Every trading day.
Only on Bloomberg.
cidade estava sitiada.
Isso ao começo eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them. Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Good morning. It's 5 a.m. in New York City. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Tech pressure waning. Equity futures cool down from days of sell-off. The dollar hits a fresh 2-week high. That's ahead of the annual Jackson Hole Symposium kicking off as the latest Fed minutes highlight inflation concerns and retail earnings continue with the biggest in the world, Walmart, as well as Ross Stores on deck today. Let's take a look at what's going on in terms of futures, and you can see that although S&P futures are gaining a little bit more, are losing a little bit more, I should say, NASDAQ futures are down now. They had been up earlier in the session and after the trade last night. Russell futures are down the most right now. So it looks like sentiment is souring as we approach the open, just about 4.5 hours away. For some of the stocks that we want to watch, let's get over to Valerie Teitel. She's standing by in London. Valerie?
Good morning. Let's start with some earnings off the back of Coty's earnings. A surprise loss of 2 cents per share has seen this beauty and perfume retailer conglomerate, should I say, drop 21% in pre-market. Now, Coty owns brands such as Rimmel and CoverGirl. There have been ongoing a 5-year turnaround plan. It still seems like they do have some room to go, but there were some warnings on the consumer on here. They're seeing soft consumer demand, and that is causing a buildup of inventory. Let's move over to the tech sector. Some positive news for CoreWeave. This is the AI data center company that went public back in March, up around 1.5% after some regulatory filings showed that Jane Street has taken a passive stake in the company of around 5.4%. And lastly, Walmart, as you mentioned, the big one on deck today, reporting before the bell. Walmart being one of the largest private employer of Americans, should I say, reporting before the bell, down 1% so far in pre-market trade. Now, note, Matt, that they're previously in their guidance, it was very, very conservative in the last quarter. So there are some bullish expectations and some expectations they upgrade their guidance now that we have clarity on tariffs. Matt?
Yeah, the stock up 14% year to date. So a little bit of a sell-off in the futures, but investors are definitely positive on this stock. Valerie, thanks very much for that. Valerie Teitel in London. In just moments from now, Freya Beamish of TS Lombard joins us to discuss the Fed's rate path. And then later this hour, we're going to look ahead to Jackson Hole, JP Morgan's Kelsey Barrows. So some important analysis that you don't want to miss. Now, that symposium, as I said, is kicking off later today with Fed Chair Powell set to speak tomorrow on Friday. Let's bring in Jill Deeses for more. Jill, what